If I only had a crystal ball. Every investor has probably made this wish from time to time. We would all like a way to avoid the emotional pain and anxiety that inevitably comes when our portfolios lose value due to the inevitable market downturns. Surely, a perfect investment would spare us that pain, right? Suppose a mutual fund manager with a crystal ball knew which 10% of the 500 largest U.S. stocks would earn the highest return for each upcoming 5-year period. I mean, imagine investing only in those stocks should ensure a gain and no pain, right? Well, according to an article by Bob Veres, who's editor of the Inside Information, someone has looked back over more than 80 years of data to track such a hypothetical fund. Alpha Architect, a research company, divided the 500 largest U.S. stocks into deciles and imagined a fund investing in only the 10% known to have the highest returns for the next 5 years. Beginning January 1st, 1927, the hypothetical portfolio was adjusted every 5 years. If you could have it then and held it to the end of 2009, you would have earned just under 29% a year. Wow. Lots of gain. Lots of gain. And no pain at all, right? Well, except for the particularly bad bear market that started in 1929, when you would have seen your investment plummet almost 76%. Or the 1-year period starting at the end of March 1937, when the fund would have fallen more than 44%. Or the 9 more times over the years that the fund dropped by more than 20%. It lost 22% in 1974 when the S&P was up 20%. In 2000 to 2001, you'd have watched it plummet by 34%, while the S&P was only down 21%. Or how about the 20% drop from the end of September through the end of November 2002, at a time when the S&P was sailing along with a 15% positive return. Yes, the long-term returns in this perfect investment were amazing. The full ride, however, offered many opportunities for anxiety, and I would say even terror, when investors would have been strongly tempted to bail out of this failed experiment. Alpha Architect concluded that even if God, who presumably doesn't need a crystal ball to have perfect foresight, were running this mutual fund, he would have lost a lot of investors. During the rough patches, many would have lost faith in his management skill. Investors who are ultimately successful learn to hang on through thick and thin, knowing that at the end of the day, the markets recover. Yet even if we could choose a perfect investment, staying with it for the long term is a tremendously difficult challenge. One of the reasons market declines are so frightening is that they happen much faster than market gains. Ben Carlson, author of A Wealth of Common Sense, Why Simplicity Trumps Complexity in Any Investment Plan, looked back at all bear markets and bull markets going back to 1928. The bull market rallies averaged 57% returns, while the bear markets averaged losses of 24%. But the bull markets lasted an average of 474 days, and the bear market drops, they were more intense. They were compressed into an average of just 232 days before the next upturn. Even when, by percentage, the gains far outweigh the losses, the more gradual pace of the bull markets don't attract our attention in the same way as the heart-stopping downturns of the bear markets. Varys calls the Alpha Architect research, quote, a lesson in humility and patience. We can't look into the future with a real crystal ball. However, looking back at market patterns with an imaginary one can help us protect ourselves from the tendency to bail out in the face of adversity. Thanks for joining me.